Welcome to everybody. Quick update. What are we going to be talking about today? Yes, we're going to talk about oil and gold. That's right. So roughly 2 months ago, we said you should short oil and you go long gold, and you'll actually have a commodity delta neutral trade. That is better than just going long gold or just going short oil. It actually gives you a much less volatility. So if you get dollar weakness, for example, gold goes up, oil goes up, you get a kind of balancing. However, if you get really strong dollar strength and it's slowing your gold long out down, you get the benefit of the weakness. But more importantly, we saw technical signs. It wasn't fundamental. So the fundamental argument is, this is a debt-based collapse. Have you ever heard me say that before? The first 4 years ago saying it, and saying that market has turned, and it's turned irrevocably. That means pullbacks will be small on the rates, and then they'll be long on the high side, going higher and higher. You're going into a debt devaluation cycle. What Volcker did when he raised rates, he devalued the debt and gave a lengthy period of stagnation known as stagflation after Nixon and the Vietnam War, where more bombs were dropped than all of World War II by the Americans in some place far away that they had no business. As a result, people started calling for the gold because they were printing too many dollars, and they suspected that there were more dollars than there was backing. And suddenly, in 71, the gold window closed. Faulkner devalued that debt by pushing rates up. Remember the seesaw: rates up, debt valuations down. That's the key thing. You can check out our Substack, don't forget, also in the links below there. If you want to buy gold, links below, pure gold, and for our US friends, ITM trading. And if you're small amounts, start accumulating monthly. You can start small. We all start small. It's okay. Anyway, when we were talking about that particular trade, we actually expect the oil to go down in dollars and the gold to go up in dollars. So in fact, for you to win on both ends, not just to reduce your volatility by the fact that you are split a commodity group. This is a debt-based failure. Therefore, the alternative monetary system, which is actually the original money system, aka gold, is going to highlight the inflationary fiat proliferation, debt creation practices of the central banking cartel. So, in a monetary failure, you want gold. That doesn't mean because it's a commodity and oil is also a commodity, you want oil. What's actually happening is rates are pretty high for the average retail consumer. Remember the twisted balloon analogy? There is one part of the balloon that is getting all the air pumped into it, and there's another part that is deflated and flat. That's you, the retail consumer. You're not having it so easy. However, the military industrial complex, the pharma industrial complex, the media industrial complex, the sending money to Israel, the sending money to Ukraine, Upper Israel, and all the other geographies where they want to proliferate warfare, and is going just dandy as a business practice, as you are seeing. And they're working on Georgia, trying to achieve the Ukraine effect. Hey, didn't you see what loveliness is happening in Ukraine? Isn't it time for you to give up some blood and open up a new front? Let's savage all your Christian Orthodox males so that we can also pimp out your woman, etc., etc. Anyway, I sense a little bit of divergence. So let me come back to oil. So where was it? Let's have a look at this. This is our channel. We spoke on oil going down, and we have to go back some way, around about 2 months ago. Here you go. Shockingly bad payroll reports, why it's time to short oil. Oil market crash, why central banks want to destroy the global economy. We were talking about that on the shorts we put out. It was actually just after our Rick Rule in Florida. There's us talking to Keith Neumeyer of the silver miners. Don't forget to check that out. You can also see David Wu, who was actually called the Japanese yen to have a reversal, which was quite a good call there, etc., etc. So that was in and around 2 months ago. And you can see we're getting a few views there, not too many. People don't get fired up by that. Well, let me tell you, it's one of the most important things. Bond markets and oil markets. Oil is the inflation, and they go hand in hand. So you spin the wheel of oil price up, the inflation starts to climb, then you get interest rate increases, you get bond devaluation. It's amazing, these interactions. and what they mean. So we're doing an update on that, and I want to point out that update. And let's go straight over to our oil chart and just give you a wee reminder. In actual fact, this is quite a big time frame. Give you a wee reminder of our history with oil. This is a monthly. I'm going to just turn some of all the numbers off. This is a monthly call period with oil, and I want to highlight that actually this event here, that was the events of CV20 19 into 2020, we called the first time for oil to trade in single digits was our call that we made, and that's the first time in. The last time it was in single digits was 1974. So we sat here shorting in the upper 60s to mid 60s range and said, you're going to single digits on balance of probabilities. People are mispricing this possibility. And that was on stage in, and I will show you the video and the case study. So what I'm finding is interesting. You make outrageous, super bold macro calls. No one else makes them. You stand out there alone. You talk about your views, like the debt reversal, which is the single biggest of those calls. And nobody does those views. Then suddenly, 3 or 4 years later, Zero Hedge runs an article. Then Stanley Druckenmiller comes out, and Paul Tudor Jones comes out, and you find out there's a whole bunch of other influencers now on Twitter that said 3-4 years ago they called the end, and they're showing the chart with the blow off. But they never had the courage to actually say that 3-4 years ago. Now they're retrospectively injecting the analysis now that the big guys have permissioned them to think the unthinkable, that the debt markets have turned. I find it very interesting. We stood alone with that one. People were shocked, and we continued to say from 2020 that the events of COVID were in fact a book ending of a major bull cycle, and that it was far more seminal than people realized. That 2020, going from 19 into 2020, was seminal, financially seminal for the debt markets, seminal for everyone. No one said that. Now everybody's retrospectively saying they did 3-4 years ago. It's fascinating. So we case study everything. We have our data charts, and we put them out there, because credibility in a charlatan world where everybody wants to steal glory, I actually get annoyed and competitive about it, and I shouldn't. I should just accept that charlatans are charlatans, and everyone will tell you. The problem is people's memories aren't there. If people see it turning early and they start suddenly changing their tune, no one notices when they pivoted or when they really were saying something bold. The problem about being too early is that everybody else has forgotten what you told them so long before. And that's why you have to document. So that event right there was our 2020 call. By the way, we were also engaged in that event, which I'll also show you. By the way, there was a Ukraine war that was starting round about there. When it turned and couldn't go higher on that Ukraine war, we pivoted to it being an inverted. We said there's a major move for oil. It could be up or down. We're waiting. Then we saw the Ukraine war. It had that little run. The minute it had run a 103 technical indicator, we were short on that. And boy, did it go. I never thought, one thing I never short, we knew about overperformance, but I never thought it would take out the subprime lows, yet it did. So let's just show you the analysis. I wanted to show you the chart that saying in 2020 that you would trade in single digits was saying in 2020 an event that last happened in 1974. 26 years plus another 20 years. 46 years ago, with all the inflation and everything. It was a ridiculous, ridiculous call. And it came off. So we have history with oil, as we did there again. And funny enough, I didn't choose oil. I didn't choose it to be my friend. I've never particularly thought it's my place or anything like that. I've not been a miner. I've not worked on anything apart from hearing that, the divers on the rigs made a bunch of money and I quite like diving. Oil, that isn't particularly my thing. I grew up in South Africa. There's no oil down there. There was gold mines for sure. But anyway, your markets choose you. You don't choose your markets. And it has been very substantial calls that were made on that. And the reason I give you all this backdrop is to remind you that A, there's people that make real forecasts and say them when they say them and stand by them and are really early and give you a real macro insight and allow you to bias against something that is totally useful and often turns out very, very profitable. And there is a multitude of trades in this as well. And I want to give you this backdrop because I'm going to reiterate and I'm going to show you something on the current oil market for the future. But to accept the future, you also have to know the past. These were the charts taken with their date and time. This was after a major capitulation after we re-entered here. We were actually stopped out with a drone strike on Aramco by Iran. Iran bad. Absolutely constructed headline as far as I'm concerned. Probably nothing to do with Iran, but it got a little bit of a bid under the oil, which was lagging and looking heavy. We got straight back short. We were stopped. Yes, we tell you the facts. We got stopped. We put back in. Super tight stops. We're okay with it. We often expect to have 3 entries before the one that pays. That's how, but we're very aggressive on our money management. We allow up to that 3 entries. So this was it talking about in 2019 in Cyprus about how oil was looking weak and why you should be trading plains all American, the equity, reminding people of our inverted HVF call in 2014 with Ukraine. And then they came out and said this hedge fund was the earliest to short oil at 93. And we were like, we were there $10 before. What are you talking about? So there's always heroes. They have big names that they are known. PAA, we called a massive 85+% market cap decimation on a major pipeline company. That's what happened in our case study that we're showing you. These are the trades and the blotters. You can click on them. You can see the entries. You can see the risk rewards as they were being presented. They were screenshot. Not only do we expect something, we have enough confidence in something that it's going to be outlandish and is going to shock people, we take the images as it's happening before the targets are made. There's the drone strike and our stop out and re-entry. We tell you the whole story. The pain of having to stick with it that went in. And we show you when it happened on the charts. There was the little pop out. We got stopped. We had a stop there. We got stopped by that spike. Failed entry, re-enter. We got to re-enter higher up. That then is a log scale chart of something that traded over $65 that ended up trading naught because people didn't have the space to put it. That's what's called a glut. And that's what happened in that instance in oil. So as I say, all the charts and the images taken with their outcomes. These were scenario casts that we had bid with this capitulating before it happened that we were sharing within the community, pointing out that you were in a 15-year falling wedge, which was going to set up a major run to the upside in due course after a capitulation to the downside that would need to meet by our methodology, try spit the words, Francis, our basing descending grind line that was part of a 3 impulse falling wedge that you'll learn all about. There's nowhere on the internet, go Google it, you're not going to find it. It's our technical experience, it's HVF method, and that's where you come for real macro big time frame views. Like 4 years before Stanley Druckenmiller, the bond market has turned, you want to be net short. This is a debt failure. Calling it clearly, specifically, people don't realize using the phrase book ended. Fokker 1980, you guessed it, 2020, major proliferation of quantitative easing. It's the first time ever we made a bond market call in years, and never called the end of the bull. And in that time, we had nothing of other influencers talking about buy bonds, wear diamonds. Because for 40 years, you bought the dip on bonds and you made money. For 40 years it happened. They'd learned it so goddamn well, they couldn't see anything else but that. Many influencers with far bigger followings, far bigger YouTube channels, and this phrase, buy, bond, wear diamonds, almost made me puke every time I had to hear it, because it was deathly. It was deathly. It was at the wrong time. Anyway, there you were. You could see you're at 57.82 on the oil market. We were calling weakness. And again, we are saying it would be so violent to the downside, you could run the single digits. That were the forecasts of the charts that we were providing. This was where we were on the oil. This entire case study, including Carnival, which was essentially a cruise liner, one of its biggest costs being oil. It burns grease to get the boat pushed through the water. It takes a lot to move water out the way, a lot more than it takes to move air out the way. And we didn't understand how oil going cheap would also kill a cruise liner. We had inverted structures on Carnival, right here, right there. You look at it, low 1, low 2, low 3. We're saying, why is this falling so far? Target was right off this image here. At the same time as we have such high conviction on the oil going down, when the biggest costs go down, what's going to happen? That's bad for a clientele of old people being put on a tin can packed on top of each other. What's going to make it really bad for companies that have those kind of clients? What kind of environment? And you got your answer, and it was obvious. The spiller, the thriller that eventually came along with the break of the virus. And you can see the technical entry stops all playing out. So these aren't calls that we just make for callers sitting here like analysts that throw calls out. We're real traders. We actually trade our shit. If we say something and we believe in it and we put it out there, we do it. Okay, and there's a lot. It's very frustrating in an environment where there's so many wannabe stars that say things but never back their money with back it with any form of money, and there's no social proof that they've done it with any form of money, which is why we started doing our results page and our case studies on major macros. You're looking at probably the only person that does macro technical and makes ridiculous calls as they are happening, because we made 4 years ago the bond market has turned cold. We made in 2019, which is 5 years ago, the collapse to a single-digit potential of oil on a stage. I will show you that video in Jeff Berwick's Acapulco. That was then in the February. It had already started slipping. We'd made it all of 2019. We made it at an event in South Africa in November in 2019. We repeated it again in February the 14th. It was almost Valentine's Day to the day. Aramco suddenly deciding to IPO and give loads of shares. We said that is further proof to us that the cartel know that this plan is coming and that it's going to be a killer for oil, and they are handing, in a benevolent sense, the opportunity to their citizens to buy shares in the Saudi royal family's entire ownership. Of course, they took in their money, gave them the shares and flushed them out and bought them back a whole bunch lower down. We pointed out that this is typical of control structures, cartels of absolute corruption, to do that and to turn their citizens into bag holders. Everything was lining up. It gave further conviction to our trade in terms of all of this. These were the tweets at the time. These were the moves and everything that followed. Oil, Saudi, Patsy. I was in Zimbabwe. I'm sitting there. I even recognize the backdrop of where I was when that said. Saudi monarchy, Patsy's its own citizens. That's me speaking. Nobody else did that. No one calls these guys out. Premium community enters. Plains All American and CCL shorts. There it goes. Down, down, down. There's the YouTubes. There's the charts. There's how it went. Here's us with our friend Jeff Berwick on stage. In fact, that's worth playing for a bit. Let's put it a little bit quicker. 1.25 should do. I don't talk the slowest. Let's go 1.5.
Home equity through our ears. That was just slapped down that first red column. You ran alone. We traded that second short at $104. We held it for an extended period, and even still, it's surpassed our expectations. In other words, we have a pattern structure. This is part of our technical analysis. I'm the chart guy, I love charts. It's incredible that's warned us of overperformance, and we got out too soon. We actually ran what I consider a Great Depression low for economic activity in oil, and I just didn't see that coming. So that's that point over there, roughly timed with the big collapse in China. So these oil collapses also dovetail beautifully with economic activity. One was subprime, the first. The second, many don't realize that 15 to 16 was a pivotal year. Throughout that period, China became the big story. They were creating the heat while the West was absolutely on the bone.
2016.
During that period, they loaded up on debt in such a short time frame that they went from under-indebted to the most over-indebted nation of all, creating heat in the world. It's the reason that Australia just bypassed the 2008 property correction, and more on that later when we talk Aussie dollar. And that was the end of that. That was the game coming to an end. We had unofficially, as Jim Reichardt's referred to, the Shanghai Accord at that 2015-16, end of 15, beginning 16 event. Since then, there's been a little bit of a reflation back up, and we did these regular hard stamp downs. So those three yellow areas that I'm highlighting are what I anticipate will happen next for oil, potentially even a new low to the previous low. I've gone so far to say, and this is trying to be controversial maybe, but I'm saying people are underpricing possibility. They're underpricing. That doesn't mean it's high probability. Underpricing means you might think it's 0.001%, and I think it's 5%. That's an underpricing of single-digit oil. That's not
underpricing the possibility of single-digit oil. Everybody, no one is even talking it or mentioning it. That is the oil gap down. Friday close, 6th of March, Russian, you can see it. We caught it, we were watching it. Those were huge gaps. It was just, here's your P&L, have some more. Wouldn't you like that? I mean, wouldn't you like that? I'm just asking. Maybe you should. Maybe you should. Look, you don't get them every day. Macro calls are like catching marlin. It's not putting a bucket in and scooping sardines in the middle of a sardine run. You've got to wait a little bit. You've got to do a bit of work. You've got to have a bit of faith. You earn your money in waiting, toiling, hanging about. We'll do an update on Euro Swiss franc for those who are wondering. Probably the beginning of next week, if not the end of this week, by the way, for those who are wondering what's happening. If you don't get your move straight away, you want the move. This is what's happening. The market, these planners and cartels decide when the moves come. This was the post-oil crash. That's sitting in Zimbabwe, the reset, and calling for oil subsequently to go long. That was the other key part. It went down. Is now the time to buy? And then again, calling for it to go long, and that you'll go back to 3-digit oil. That was outrageous. You're at single-digit oil, and we were saying you're going to go through the hundreds. You're going to go through the hundreds in the backlash of the over one side too big, the other side, and that this falling wedge would break. We were highlighting that this, at the end of the day, was a falling wedge, and you needed a final capitulation to the downside, and that actually you were going to get a move to the upside of significance that would take you through $100 in due course, which is exactly what happened. Here was the final high at around the 130s, where we said broadening structure. This is a broadening. Final high 129.47. You broke your splitter there. We said this is a broadening structure. It's getting too volatile and broadening out. You could short there. You certainly should have been short there. You would have been short at $116 or $124 after the rebound of the falling wedge breakout to the upside. Everything on the oil market that we've literally called the high as well as the low. Show me a commodity-based analyst, and it's not even my specialty. This is macro HVF technical method. That's it. There's a million people who know way more about the oil market than me, right here, right now. I would actually say ignorance is almost bliss. I'm a macro technical guy. I'm not an oil guy. But somehow we called single digits, somehow we've called the top and shorts, and somehow we're reasserting, and I'm going to bring you to the present, oil short. And this is something this is a transferable skill. You can do this too. You can do this too, or you can be in a community while someone else is doing it while you're learning it. You know, watch, follow, try, do. You know, I can send you a video on how to ride a bicycle. In our community, you actually watch me ride the bicycle, get handed a bicycle, and get told to pedal. Fall off, get picked up, fall off, get picked up. Don't fall off, go for a nice ride. That's how it goes. In an environment that's designed for people to learn, where everyone else is supporting you and doing exactly the same thing. There's no one juggling balls. We're all riding bicycles. It's HVF Method is the bicycle. And you can walk your way to wealth, or you can multiply your way to wealth and have an awesome bicycle that goes, you know, does 60 kilometers down the hills and does 30 kilometers on the flats, while the guys who are walking, because they don't want to invest in learning, because they think that's a loss of capital for their trading, they'd rather walk from here to Timbuktu, because then they've not spent anything. You know, if I have to spend to grow and learn and then end up on a motorbike that blasts past everybody else, why would I want to do that? You know, that's what we get. Oh, I've learned it all off YouTube. That's the other thing. You haven't learned shit off YouTube. You haven't learned anything off YouTube, and you haven't got the confidence to back it. Let me tell you, you know why smoke enders exists? Because people have to be that determined to finish smoking that they pay somebody else. And then they learn about, hey, you've got to substitute, you've got to do this instead of that, so that you don't have this void. You can't have void. And then they actually realize they learn a whole bunch of stuff and they don't fall into the traps and they do finish. But you have to be that pissed off that you're prepared to pay to want to end it. That's why they exist. And then you find out they actually have some techniques and they actually will show you, and you can, and you're that determined. And it's when determination not to fail, determination not to walk the way to Timbuktu, but to fly there first class is much better. And sometimes you have to buy a ticket to do that. And that's what investing in yourself is all about. And for that, you click and buy for nothing our mini course below and decide, is this guy consistent? How long's he been out there? Free mini course. And then if you've watched that, only if you've watched that, you think, I'm ready for a conversation, then you book a call. That's what happens. So this is oil. This is oil, how it's gone. And we're going to bring you to what we want to talk about soon. But this was detailed very, very clearly. No one loves charts more than me. That is an absolute spill. This is such a clear last final gap, exhaustion gap. We teach you about gaps, the final exhaustion gap, grinding along our splitter in a channel like flag, like that, marginally higher high, super low volatility. Our method is the only method that has the word volatility in it. It's the biggest gift that none of you ever appreciated. It is the asymmetric trade. Let me just tell you something about trading. It's time to bloody wake up. You trade for an asymmetric gain on a very tight risk. This is a concept called money management. You do not do one-to-one. You do not do hunches. You do not do follow my leader, some twat on YouTube said something. You do it because you can have a super tight stop and a disproportionate probability of an outcome given the reward. If you have a 1 in 3 possibility of winning, but the risk reward is 1 to 12, you take it and you lose twice. It's okay. The third time you win. That's trading. And the only thing that gives you that asymmetry in reward is when you squeeze real tight and you get an expansive move away from your stop that makes a very tight stop that's kind of risky, because stops kill most trades because nobody knows when to engage the market. And we tell you, you engage on volatility, hence the name HVF, Francis Volatility and it funnels method. That's it. That's what you're here to learn. And you learn to apply that. Only think, oh, now I know, I'll do that. No, you don't know anything because you don't know how to implement it in the market. This is a grinding flag along a splitter on a broadening structure that nobody else even draws in the world with the correct naming standards, that breaks technical patterns right down to their fundamental atomic level. Grind lines, splitters, capping ascending grind lines, basing ascending grind lines, ascending, descending. What does it mean? What's continuation? What's goddamn reversal? None of these technical bozos know how, because they've never sat down and said, write the theory of what you've observed over 40 years of watching markets. Do they even have the brain? Do they care enough to want to help people? Are they people that leave ropes up Everest so that the man behind them has an easier climb, or they're all in it for themselves? We want to help other people build wealth, but we need to kick your backsides, because we have to show you the difference between fancy marketeers, charlatans that tell you they said things long ago but have no proof, no chart captures with date stamps. Every one of these charts has a date stamp set by Snagit that takes the date, time, minute to the second. Every time I take a goddamn screenshot, I wouldn't even know how to flip it or change it, and I never edit it. That is it. And I'm wrong often. But what we do show you is legit. And that's the facts right now in technical trading that people don't understand and don't know. The 116 was an absolute gimme short. You should have, and you could have, if you were watching this, taken the breakout on the dotted grind here that was actually a flagging structure with a small spike of volatility to make a marginally higher high, run all the buy stops in there, hand them an immediate loss, grind along this level. You're at 126. You could have put a stop there at 126, been short 124. It's down at whatever it is today, and we think it's going to 52 with a possibility of 32. Now, I'm not saying you would have held the short all that period or duration. There's carry costs, but it absolutely spilled and it fell well below 100, and we're going to take you into the current oil market. But we first needed a little rant, let off some steam. We feel like Cassandra in this wilderness of charlatans, of people that are backdating every great trade. You can see this huge blow off. There it is. You can see the date that it was done. You can see exactly what it is and what we're illustrating. That short up top there at 116 on that smaller broadening up there, you would have run it very quickly down to 77 with a $2 stop. You could have been short one at 126 and short at 124, and you would have been within the beginning of 23, you already would have been at 77. You would have traded 70 at the tail end of 22. And you would have been short of just a few months before. So that's what's possible using real technical analysis. This case study is on our website, by the way. You can go and see it. And we'll be doing the bond market call as well. And highlighting how all the big boys showed up, and how we gave you their future trades before it happened. Let's get back in there. So I want to just see if there was anything else from that case study. Yeah, that was the finish. So let's take you to the actual market. Who wants to see the market? Okay, so here's what we said. Be long gold. By the way, the last time that whole short was also a gold long, oil short. That just covered the oil part of that trade, not the fact that gold ran to $2,000. From 1340. Gold ran to $2,000, dipped like this on COVID in the same month that it come back and went on to a new high. It laughed the events of CV19 entirely off, unlike oil, which is where I find us right now. There is absolute similarities to something that just played out in 2020, and nobody's even seeing it. Because we do the gold ounces per barrel, per oil barrels per gold ounce, cross analysis, and we showed you those charts, and you're going to see them again today. So now let's have a look where we are. Does it mean we're 100% going to be right again this time and massive RRRs? No, rarely is anything identical, and we're not calling single digit this time. It's not as high drama as that. But there is the semblance on a macro time frame, and there, as I say, is the low. So you've had the recovery trade, you had that high over there, you had the failed attempt to make a new high there. We called at 124 short with a 126. You saw the detail, and it ran down to whatever it is at this point. It's sub 65 because the fat blue line is a neckline for $65 with a left shoulder. So the Cassandra of the oil market has been telling people, actually, you want to be short again, and nobody's been listening. It's all a commodity bull. No, it's a monetary gold bull because debt is failing. It also is a goddamn awful consumer, retail, everyday man in the street recession on one hand, and an absolute binge fest for the cartel of oligarchy, Google, Amazon, Tesla, SpaceX, and all the other criminal corporations that are feasting off the government money that is being spewed out by Yellen. So you have a two-tier economy. This has lots of potential to be a head and shoulders. Now, many people traditionally trained under technical analysis will look at that and say, that's not a head and shoulders. We don't care what traditional technical analysts think. Traditional technical analysts are fools. They have RSIs, they have MACDs, they think that moves, that tells them what price is going to do, when price is actually the data upon which those indicators are based. There is so much that needs debunking in traditional technical analysis that they've needed a truth killer to come through it and swathe out all the charlatans selling programs with line generating mathematical formulas of no consequence that relies almost entirely on price data being delayed, smoothed out, and does absolutely nothing predictive or useful for anyone. Here's what gives you a possibility of future events. Patterns, volatility, and volume. Those are leading indicators. What might happen on balance of probabilities. Patterns, volatility, and volume. Volume is a leading indicator. Things like on fundamentals, like the yield curve inversion, is a leading indicator too, but that's a economic leading indicator. There are very few predictive forward possibility probability based. There are no certainties. You will be wrong at times, but patterns give you a much higher potential insight into a future outcome than any RSI, MACD, commodity channel index, DeMonk indicator, etc., etc., DeMonk, whatever, etc. So here you go, head, right shoulder, and there will be people say, oh, but this is much bigger and this has gone on too long. It's not a head and shoulder. We spent our life writing the book of HVFs that show up in shoulders for head and shoulders. The complexity detail of how that happens. We wrote the book for it. We just haven't released it, and certainly not to you. And here you have the armpit 1, the armpit 2. You have to specify where the head starts, where the shoulder starts. This is absolutely a classic inverted HVF, and I have a reasonably high basis of probability to expect it to make its target, which is 52.78. Further to which, so that you don't have people like me be doing a David Hunter and say, the stock market will moon. The stock market will moon. And I just keep adding more months when actually it was in a head and shoulders, crashed and made a target, and now has recovered, and now is mooning, and then I say, I told you so. We have time stops by which something has happened, and if it hasn't, we say we failed. So not only does our methodology provide you a view, an opinion, a take, a stop, an asymmetric reward to risk profile, it also tells you all bets are off, it didn't do what we thought it would do. You have to have a price point where you accept you're wrong and a time point where you accept you're wrong. Because sometimes the price point doesn't get run that stops you out and fails the pattern, but time passes, and there is an opportunity cost to absolutely everything. And you can sit and see that that should actually have made its target by November 25. Be a little bit in profit. It has to have made $52 by then. It has to have made, otherwise it's a fail. So this is an inverted HVF. I'm going to take you in on that right shoulder and show you that. So since we called it, it chopped up and down. We've been short from up top here. When we spoke on YouTube, you could have shorted over there and put a cheeky stop that's just above this. But I can tell you now that this sell-off, this blue line, is a descending pole, and this is a ascending broadening structure, an ascending broadening structure on a bearish pole. In other words, it's a basis for continuation. There's an annotation that's on the other side of that line that seems to have disappeared. There it is. And as a result, this was an expectation of a bearishness. And we were updating our community, which is exactly what you would have heard from me, saying bear pole, ascending broadening structure, 1 impulse, 2 impulse, fractalizing here. This is looking bearish. Oil could break down soon. What did you get? You actually got a gap down on a Sunday night session through our basing ascending grind line that we intentionally make red to indicate which line we anticipate to have broken. So it was always a downside continuation call, not some after timing. That line was red before it happened. That is the expectation, and it is the heavy line, and it is known as a bagel. And what did happen? You were up top here. You closed at 71.62 on Friday, and next thing you knew, you were opening at 68. I'm talking about over a $4 gap down. That typically happens at key levels of significance or basing ascending grind lines. That's why they're significant. Because when they give big. Because they've been providing some degree of grind support, algo bot buying along the bottoms, sustaining the price. When they give big. The bot gets switched off, there's suddenly no more bid, people want out, whoops, chase the ladder down. Next thing you know, you're on a Friday at 71.54, and the next thing is you're opening at 67. 67.97. I mean, there you go. That's an expectation. This pattern, the HVF, has triggered. It hasn't had a capitulation stage. All this churning is happening at our first interim level, which is that very lightly dotted line that you almost will not see over there. We absolutely expect, after you've triggered with momentum, break and feign back in, break and feign back in, trigger with momentum, run the first interim, that you get what's called the return move. That is stage 2. Stage 1 you had here, here, and then here. You made first interim, and you have return move. In fact, it ran to a wick on our axis there, literally, the midpoint of our funnel. That funnel is not perfectly in the right place. It should be on the high point there. I dropped time frames, and then the candle moved. So there you go. So what happens next? Overall, we suspect you're going to come and mess around for a while. It doesn't mean everything big's happening. But let me just say this. When the $65 mark gives up the ghost, when the $65 mark gives up the ghost, you will be in a situation where the market will probably capitulate roughly in a strong manner. I would expect, as someone who has some fundamental clue, that it will be associated with recessional type numbers, terrible labor markets, layoffs, bad profit misses by corporations, possible banking failures because of the debt related issues, etc., etc., decaying geopolitical but non-war related. Don't forget, we've got a war that's good to go at so many fronts, yet oil is weak. What does that tell you? What does it tell you indeed? So overall, we expect that in due course to break. Note how you came once, twice, and it was the third time that you really broke and made new ground. This level will not give away quietly. If you go and put on a short and you're in a hurry, it may not happen. You could be 3 weeks before it goes. But then when it goes big. As you saw with our entries on the original, the call, that wasn't the original, the one before in 2014 was the original, the call which was the biggest of them all. We actually had to get out and get back in again after a drone strike pushed the oil price up. It was absolute theatre, that, as far as I'm concerned, but they needed to do something. They weren't yet ready to let it go. So here you go. The Arabs probably needed to sell their shares in Aramco still, and they couldn't have the oil price too low. Not enough people would buy. So what is the actual call? 52 to be run. In the HVF method, we trust. We trust. And here's another thing for you as a trader that you just need to get into your head. If you respond emotionally, you will get out on pain, and greed will keep you in. Fact. Absolute fact. Only thing that gets you to close a trade is pain. Could be giving back a lot of profit, or it could be taking a loss. If you have not preordained your stops and your takeoff points and entirely submitted to a much higher force, which is non-emotional, has real geometry behind it, real trend, real pattern, real technical analysis, which is indicative and leading. And remember, I gave you 3 things that are leading: volume, patterns, and volatility. And we cover all. And our method is based on patterns, volume, and volatility. And volume by profile, volume by histogram, volume by time, you name it. We get it. We understand and want to be in the leading things, and we spend no time on anything that lags. Don't put moving averages and optimize for a price behavior that's just come and tell me how well it would have traded. If it was that simple, one of the earliest bots that can do entries for you on moving averages from 30 years ago would have been minting millionaires all along. Look at optimization of a method by data and then try it run forward and see how terribly it then subsequently performs if you want to look at systemic trading. Anyway, back to this. So that's our take. 52 is high probability to the downside. In our opinion, on an inverted, the point where this pattern fails is 84.65. It's a concern if we were to already run that stop. And for people breaking and entering, you may even have stops later. But then you don't have the HVF setup as your backstop in this fight. He's not standing behind you with the baseball bat. But you can optimize entries. This is a head and shoulder. That target potentially is 32.67 by our books. that would be quite some fall, and that would be a further acceleration, and it would be event driven, and it will be probably consumer, retail, banking, a lot of things, and oil will be cheap. Oil will be cheap. So let's go to the other thing we told you about. Not only did we say, like the previous time, by the way, which also had the same pattern on it, inverted head and shoulder. Let's just show you that. When we did gold, this is such a problem because, of course, the chart spiked to, spiked to 0, which means it went to infinity here. But you actually had, get rid of the spike, you actually had the exact same thing, which was the reason behind the exact same call and why we even made it. It's almost a similar neckline. You had the exact same thing, and we highlighted this and said, while you are shorting, complex shoulder there, oil, be long gold. Oil went 0 in the cash markets, negative in the future markets. Gold made new highs. Gold made new highs, and we can show you that gold chart at the same time. And here we are, literally 2020, and we're sitting looking at the exact same thing because nobody does this analysis. Go and tell me how many people said gold is an inverted head and shoulder to oil. How many people are you following on X? How many people are you following on YouTube that have told you that the gold in, or the oil barrels in gold ounces, or the gold ounces in oil barrels, oil barrels are head and shoulders setups? And this is gold divided by oil. That was the trade of all trades. It makes it even smarter than just being an oil short. You had reduced risk, you had another commodity, and gold went up. Even though you had the short that went to naught. The short to naught. There is no better short. You also had the long to an all-time high. That's what was given as a trade. That is the mofo of all trades, by the way. And I'm standing before you and saying, left shoulder, right shoulder, this is going higher. So let's analyze that and show you again. Because we want you to win. We want you to win. Smart people realize they get given something and they have a win on it. Say, I need everything that man's doing. We understand that. Some people don't have the means. If they make suddenly a good profit out of something, it's great. And we're happy for you. So I have been consistently leveraged long gold, despite being investing level, extremely long investment gold. I've been long leverage gold. And we told you when, and I will show you on the gold chart. But let's just do the gold side of the oil and gold trade on the gold head and shoulders here. You broke, we were watching this at 25. We felt this was going to turn. The neckline is 28. What is 25? That means 1 ounce of gold buys you 5 up and 5 across oil barrels. Picture that against your wall. 1, 2, 3, 4, 5, and 5 high. 1 ounce of gold. That little coin. 1 ounce of gold gets you that. 5 by 5 in oil barrels. And we came out and said 62. You're going through 62, probably. On balance of probabilities. Everything is always on balance of probabilities. We can always be wrong. That means not 5 by 5. It's not 6 by 6. It's not 7 by 7. It's closer to 8 barrels along the bottom and 8 barrels high. Now, I don't know how high your wall is. But if you could just get in 5 barrels, you'd not get in 8. So in actual fact, it's 5 barrels high and 12 barrels across. And you still need an extra 2 barrels on top. And this is how it's gone since we gave that trade. We gave this trade more than 2 months ago. You can see you had a nice neckline revisit here with a hammer. And since then, you've largely gone up. This is what we call your line of efficiency. If you had entered in July, which is kind of in the area of 2 months back, you would have gone that level of line of efficiency on this particular trade. It's It's steeper than a 45-degree line. That's what the Cassandra of YouTube, that the YouTube algorithm will not bring us the hundreds of thousands. The guy that gave you the ultimate short with the best long tied in 2019. We have a Cassandra complex, but all the other narrative storytellers are being pumped to a few hundred thousand. Anyway, back up to 61, 62. These are the two targets. Our first target, 53 on the most conservative draw, which means when you were at 25, that was more than a doubling. That means gold's relative price to oil is more than a doubling. Now, you either think oil's going to stay exactly where it is and gold will double. I actually think gold will double in due course, but not not tomorrow, not next week, and probably not next month, and certainly I don't even think this year. But it will double at some point. I do think so, but that's a bigger time frame that we're talking about. What is this time frame, by the way? It's not small, it's weekly. But if oil goes to 52 and drops down there, and gold continues as it has done, you will be off to the races. You'll be making P&L on both sides, and you will be inside the commodity complex neutral to the dollar. And in an environment where the rates could suddenly rise because of the collapsing US debt, the dollar could climb. And it's kind of nice to have hedged out anything the dollar does by being gold long, oil short, and winning on both ends. So let's talk about gold. How long have we been aggressively bullish gold? Well, we had an upside HVF there. Finally. This was very close to lows. You were below 1100 at those lows. This had a beautiful falling wedge, and we suggested that you could get in early on this upside HVF by entering at the breakout of that falling wedge with a stop there. That's called really tight risk. Remember what I said. To win in trading is not to be always participating. It's to be there at the moments at low volatility. Why we have V in the middle of the method that we purport. Volatility, low vol, tight stop, with a reason to suspect a direction that will move impulsively away from your stock and be the purport to being part of a far longer, bigger trend, where we can use patterns within patterns, and HVF or this time frame in a much bigger time frame on another scale. So with that said, that was one of the best HVFs you entered, and here was your events of March 2020. This is a 2-week time frame. You had volatility. You traded up to 1700, having got in at around 113, just sub 113. You got dragged down and back up and continued to new highs on a flag where you ended up. So with the oil trade, you ended up at 2075, having got in at under 1300, about 1290. 1295 on this upside HVF. You rode it all the way. We had an HVF long setup for you on the gold that shook off within a month the entire events of locking down the entire planet. That same move that actually sent the ultimate short to zero, never traded zero before, went to zero, and futures market went negative on account of lack of storage. That's what happened. The biggest short with the biggest long inside the same crisis. This market moved up, 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 shook off the biggest event economically that's ever happened. That same event that later on in the end of 2020, we would say, so big is that event, that's the end of the debt market bull. So much of this is around the CV19 narrative. That's it. And since then, you've been in a broadening structure continuation and frustrated. And we said, never fear, when you get through the 2000 level, you will have a setup, a winding up, which will then trigger a real move that will show you that that was all one long continuation pattern. From here, 2020 June was all one long continuation pattern that you had to sit through, and your rewards are in fact coming. We got in, let's change the time frame, This structure over here, let's take it to first the weekly and then down to the 3-day, the weekly, and put the lines back on. There's your 2000. We got in on an RL2 that actually traded as low as 1984. Sub 2K. You had broken the 2K 3 times. We suggested to you the 4th is your lady, and that will give you a support, and then you'll get a winding up that will start a move to end all moves for you if you positioned correctly. That upside HVF, leverage long in gold, taken on an RL2 is now like that. That's your triangle of time in trade for gain. If you invested, if you leverage trade, that is the kind of return HVF method gives you. That was the setup. We drew it. Why? Pattern, volatility squeeze, volume. All three were present and remain present, and you've just had an unbelievable overperformance move that has taken you almost to the gateway stop we gave you for the first major rest period in a far longer move, that is the doorstep of 2,900, on the suggestion that they will not want 3K to run almost in the same year or within 12 months of the 2K being run. And that could be a rest point, and that's coming up around about there. You still got a bit more upside to go. That's the guidance we gave on this channel. With that, we also gave CV19 wise for long. So we have been a bull. Have we always been a bull gold? Do we just come out bull gold because we're South African and we grew up on a mine slump? No, no, no. We've traded gold short and silver short many times, but not in these circumstances. Okay, so I've shorted on the downside silver at the levels we are now at after the 2011 highs. I have all my history of trading for people that just think we perma bulls on precious metals and gold bugs. Okay, there will be a time where you will want to exchange your gold for land and other assets where it has been hyper overvalued as everyone else overshoots and over emotively overreacts, for which point we are still a long way away. So that is the gold market as well right now, and the macro trade remains gold long and oil short, and it is very similar to me, and it's worryingly similar because you don't normally get back-to-back history redos like that. So maybe this one fails. Don't bet your shirt. That's not what money management is called, a sized loss. But it is our expectation that a single ounce of gold will get you at minimum 53, and it's been that way since here we were guessing it, and we treated that as a triggering and that as a return move since 28, and that it will. So that is a doubling, 100%. To get to 56 from 28 is a 100% move. You're now already at 40. However, we think you're still going to get 62. And the other key thing about Head and Shoulders is that they inherently have overperformance in them. The structure has a target, but they are typically trend change events. So after pausing and resting, they often go on further. So you may not want to close 100% at 62 barrels for 1 ounce of gold. You may say, I'll close half and I'll leave the rest on the basis of a trend change. You may have a super spike if we have real events, much like we had CV19. Who knows? Maybe I'm busy calling the next scam, finishes with the word demic. Again, I don't know. We'll have to see. But it's kind of bizarre. But if it's there, I'm going to see it and I'm going to call it. So that's what you get with HVF method. You get original, real proven cases of macro technical calls, bold macro technical calls that can always be wrong on an on balance, a probability basis, that use only leading indicators, which for the final time are patterns, volatility, and volume. Everything else in terms of charts is a lagging indicator. Every indicator, RSI, stochastic, all of these, I see them and I kind of snigger. I look down and I feel sorry for them. It's kind of like driving past an adult on a bicycle that has trainer wheels on his back wheel. I go, you really could have just left that off. Maybe you're ready, you know, but hey, maybe that's just me. Because I had them and I realized what I had at one point and said I didn't need them. But people can hold on to their security blankets as long as they like. It's not for me to fix their world. It's here for me to tell you what I see as debunkable garbage and what is really useful. And clearing the most useful, you think, you can go and read. I went and read everything and became the best educated analyst that consistently lost money. You can read, you can check every indicator. We'll get guys, occasionally you'll get the odd person and you'll think it's more about how many different methods he can learn. And I say, you come here for one. You do one thing very well. That's all. That's all you have to do. You know, you can be a brain surgeon who's just got an incredible hand at removing tumors. And everybody comes out good from your work. That's it. You don't actually have to do anything else. Your life is built on that. Don't go, hey, maybe I'll do, you know, circumcisions on the side and hysterectomies as well. Let's have a go because I'm awesome. No, stick with the method that will never let you down. Submit to process, follow the drills, and you'll come out winning. You don't have to master everything to make money. You have to master one thing to an exceptional level, or you need to be decently good on an exceptionally powerful tool. That's it. And actually, I'm not the best surfer in the world. I just like positioning in some of the best waves. And I'm good at spotting the big macro waves. And there's not enough people looking on the big macro charts calling this. And that bond, I have to take you into the 10-year because this could be a turning point. And this is my final, I'll call it a gift or an opinion for you. But the bond market, by the way, small sidebar. We're giving gifts today. I mentioned that PAA, Plains All American, was part of that oil short. And I'll explain what I mean, how head and shoulders are relevant. This was a macro head and shoulders on Plains All American. This stock traded $60.97 at one point. Had a lovely little small inverted HVF. We came in and we shorted it on the high side at around 24.50 and we put a stop at 25.45 at that high. It started to go in our favor, came all the way back and almost stopped us out with that little oil drone thing. This one, the first entry was good the whole way, but we were sitting on a box for a while and then it spilt. The reward was from there at 24.50 all the way down to a $3. Remember I said an 85% market cap decimation? We took something barely under, short at barely under $25, 24 and some change, and we said this is going to $3 and some cents. That is 1/8. 1/8 market cap. A 1/8 of its current market cap call after it had already lost from 60 to 25, 50%. We said it's getting another 7/8 haircut. That, by the way, for those that have problems with my head and shoulders, was a target of a left shoulder, another head, a right shoulder, which has an inverted high quality HVF in it that we spotted. And it absolutely spilt with the best line of efficiency. You see that blue dotted line? That's if you got in at the just in time. That's if you got in when we got in. Slightly flatter, near vertical line that took equity right down to $3. By the way, it in fact traded in its overperformance and the crash low $3. Dead. $3 dead. And since then has been grinding its way back and has just broken this basing ascending grind line after returning to our funnel of the macro original call, rolled over and leaving this monthly chart, which I've now given you, of history of what happened on this equity, along with our short oil call, which also had short carnival call, which I will be leaving out. And if I take you to the 4-hour time frame, as we are breaking that bagel, what do you therefore have? You have another head and shoulder. And this is why I say you think that's the target of the head and shoulder, but that's just the first point of rest on something that potentially could go a long way down again. And of course, this is not quite an inverted HVF, but it had a basing ascending grind line. You could have been short at 17.29. You would be looking for 14.20 and quite a bit more, I suspect. Bearing in mind, oil, if it goes to 52 or even through the 32, which could actually see it trade with a 2. If you have a target of 32, it's not impossible to trade 29, is it? In some sense. In our targets, rarely do you stop on the line. It's usually run through, as you see. So this is another key event in oil that is being replicated in the break of that basing ascending grind line. The entire recovery of the stock from $3 to the current levels of 14. And only, if I showed you that chart, only an HVF trader has that head and shoulder. Only an HVF trader has that inverted HVF. Only an HVF trader got that target. And only an HVF trader with a bagel sees the relevance of this fall through that line with the oil market risk and the head and shoulder. And that's why our method is all you need. Become decent at implementing HVF method in a community that are all riding the same bicycle, and see the power of submitting to this exceptional method, which is only made up of leading indicators with higher probabilities of outcome that allow for super tight risk and asymmetric rewards. And go watch Paul Tudor Jones, go watch Druckenmiller and all that they say, and everything they say to you will be, because there was a tweet out there of his, I wish I'd bookmarked it, where it says everything is about money managing and having super small losses and macro gains. You do not trade the 1-to-1s. You do not trade the 1-to-2s. You look at moments where you can risk as little as possible and get as much to gain. This is, you need to be an Arab haggling in an Arab market. That is always wanting something for nothing and prepared to spend the time to save every little cent. That's how you trade. That is how you trade. Managing losses and ensuring that the fact that you're going on risk is giving you a real chance of exceptional rewards. HVF method is it. Go and click the link below that gives you a free course and an introduction. See more about what I talk about. And if you some point feel that you want to have a discussion, we need to speak to everybody to understand their expectations and ensure they're not overinflated. Then you can talk, call an agent and have a chat. And by the way, we have a US agent, we have a UK agent, we have a rest of the world agent, people that sound just like you. I know it's weird. There's a bald guy with a South African accent, some far off. We are stuffed with amazing Americans. We are stuffed with great English people. We are stuffed with Australians. We are stuffed with New Zealanders. They all took the plunge and they're all glad to be. We have members of 5, 6, 7, 8, 9, 10, 12 years standing. We've been running for a long, long time. Click that link below, get your free course, understand the true virtues, understand the value of macro biases. I am not touching any equities that are reliant on oil. And think about what it could do for gold miners if the oil price goes down and gold is going up. Okay, till next time, I'll catch you later. Bye for now.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.